Absolutely, positively, without a doubt. And I think, by the way, that we're in for a bull market that has legs. That is to say, a fairly long duration. I say that because my observation over 50 years is that precious metals do well. And I should caveat that and say we're in a precious metals as opposed to a broad resources bull market so far. But precious metals do well when investors are concerned about the maintenance of their purchasing power in fiat denominated savings products. Uh, I There is no doubt whatsoever in my mind that the world's preeminent savings product, which is the US dollar 10-year treasury, is really, really, really challenged. I believe personally that in an absolute sense, the purchasing power of the US dollar declines by 75% over 10 years. I'm not talking, by the way, about the relative value. I'm not talking about the US dollar relative to the euro or relative to the pound. I'm saying that in an absolute sense, the purchasing power of the US dollar will likely decline by 75% over 10 years as a consequence of debt and deficits in the US society. That happened, Kai, once before in my life, in the decade of the 70s, 1970 to 1980, the purchasing power of the US dollar fell by 75%. It's no coincidence that in that same decade, the price of gold rose 30-fold. I'm not suggesting to you that the gold price rises 30-fold from here. It's already risen 12-fold from 2000 to 2025. But I think, Kai, not as a certainty, but as a possibility, that the nominal price of gold increases to a degree that reflects the decrease in the purchasing power of the US dollar. If that arithmetic symmetry holds, it would not be unlikely to see the nominal price of gold increase threefold or fourfold in the next 10 years. Meanwhile, in the period, 2022 to 2025, we've seen a substantial increase in the gold price. And beginning in 2024, we saw that increase in the gold price outpace the increase in the cost of producing gold. The consequence of that is that the biggest and the best of the gold miners have seen free cash flows not increase, but rather explode. And you have seen the combination of that increase in free cash flow and the beginnings of the appreciation of the gold market narrative give us a legitimate gold bull market. It's acting just like prior markets. The market was led by gold. Then, when the margins began to increase, it moved leadership. When I say it, leadership moved from the bullion to the best of the best. It's now cascading down to the best of the rest, and in very rapid fashion, even to the juniors. It's important to note, however, that the valuations for, let's say, qualitatively, the best 15% of gold miners or explorers relative to their net present value at today's gold price are not excessive. I interviewed Amar Al-Jundi, the CEO of Agnico Eagle, at my conference in Boca Raton. And we made the case that despite the fact that over 18 months, the price of Agnico Eagle has doubled, if you look at the net present value of the cash margins that Agnico Eagle delivers at $3,400 gold, relative to the cash margins that it delivered 18 months ago at $2,200 gold, the truth is that the company on a net present value is cheaper today after doubling than it was 18 months ago at 50% the current price. People need to understand that value is relative. And that's a very, very important understanding. At the same time that you remember that valuation is relative, remember my earlier admonition, which is to say that 80, 85% of the stocks aren't worth anything at all. So there's no particular point in valuing them. I'm surprised at the strength of junior mining financings for the best of the best. In the last 18 months, I would suggest I'm a reasonably well-known investor. I'm told by issuers that my presence on the roster by itself has promotional value. So I would suggest that somebody like me should be treated well. I wrote checks in bad times. I write checks in good times. I'm saying this not as a commercial for Rick Rule, but rather to point out in the last 18 months that most of the financings that I've wanted to participate in size, I've been cut back. The industry claims to be underfunded, but the high quality companies are not underfunded at all. We've seen juniors go out to raise $30 million, stop soft circling the book at $50 million, upsize the offering to $40 million, and sell out oversubscribed. This is not a market where deserving companies are wanting for money. This is not that market. Having said that, the valuations in this market are uneven, as the valuations always are at the beginning of a gold bull market. The biggest and the best have moved first, as they should and as they will. Valuation discrepancies in a bull market begin to appear between the largest, finest, and the most liquid companies and other companies. And either valuation arbitrageurs, people like me, begin to allocate further down the space, looking for absolute or relative bargains, or the big companies with high market caps take over the small companies. Cost of capital is a durable competitive advantage. So the progression goes from gold to the best of the best, to the rest of the best, or the best of the rest, depending on how you call it, to the more marginal producers that generate more leverage, to the single asset producers who are viewed as being riskier, to the high quality developers, to the high quality explorers. The money cascades down the quality chain. And this one is following a predictable path. What seems to be happening, perhaps as a consequence of social media, I don't know, but the money is cascading down the quality chain much more quickly than it used to. We're seeing extraordinary strength in the financing market, even in the high quality explorers, never mind the project developers, which is where we would have expected the money to go. But this is acting very much, despite that, in the way that the prior three precious metals bull markets in my career have unfolded. I can only speak to the grassroots explorers that I'm trying to invest in, which is a fairly select subset of that. The prospect generators, which is where I prefer to concentrate my grassroots exploration efforts, have been uniformly successful at raising money. The grassroots explorers with recognized high quality teams have been uniformly successful at raising money. Companies with the third dimension, which is to say a good drill hole, validating surface data, have been able to raise money. But I'm seeing increasingly the lame, the halt, and the blind with access to a good narrative also raising money. There's a lot of bullishness in the United States, as an example, about the return of exploration and the return of production to the United States, given a changed regulatory climate and the fact that the U.S. government, rather than standing in the way of mining, perversely has decided to subsidize it. And what you're seeing now is, the typical global scamster who sells narrative as opposed to reality, staking a bunch of jackrabbit pasture somewhere in the American West, claiming its perspective for gold or uranium or titanium or vanadium or rare earths or whatever the flavor du jour is, saying that they're coming to market with only a $3.5 million pre-money valuation, when the truth is they're worth nothing. You are seeing those guys getting financed. That's pretty easy, actually. If you look at the fact that there's probably 500 mineral exploration or mining companies in the world, I can't follow all of them. So going where I'm not is not a very difficult thing to do. I'll give you my favorite junior methodology. My favorite junior methodology, and most of your subscribers won't have the guts to do this, but my favorite methodology is to find a good experienced team in a commodity out of favor where there is strong data to suggest that their target is tier one meaning over $10 billion and hopefully over $20 billion in situ recoverable reserves and resources at today's commodity price. That usually happens in an out of favor commodity, and it usually happens in an out of favor space. When I'm fortunate enough to see all of those things in one wrapper, particularly where it's out of favor enough that the market cap is sort of sub $100 million, which suggests to me that I can, over 5 years or 6 years, enjoy a 20 bagger. I can't resist that. I absolutely can't resist that. Mercifully for me, most of your subscribers can resist it, will resist it, and do resist it. They want a hot story, they want momentum, and they aren't willing to wait 5 or 6 years to get paid. The easiest way to front run me is to find something that has the same type of warts that I prefer: boring, out of favor country, out of favor commodity. Right now, however, it is likely, I don't know that you can front run me on this, but you could right now probably continue to buy the gold optionality stories, particularly the stories that are producing, that aren't efficient producers, but will enjoy expanded margins at today's gold price. I think you can do the same thing in the mid-cap copper companies. Here's why. If the purchasing power of the US dollar, as I suspect, declines by 75% over the next 10 years, building new productive capacity, building what is today $1 billion gold mine, becomes building a $2.5 billion gold mine. And the replacement cost of today's assets is going to rise. Meanwhile, predicting what the gold price is going to be in the future, which is to say, putting money into an advanced exploration play or a development play that's going to pay you 4 years from now, is going to miss 4 years of net present value at expanding margins. The place where my portfolio is weak is in gold companies which have all-in sustaining costs in the worst half of the cost curve, because I've always focused on companies in the best 25% of the cost curve. People who are willing to do the analytical work that can find companies that are substantially undervalued at a $3,200 gold price, that are already producing, that will generate, like Oceana Gold as an example, 14 or 15% free cash margins, where they have decent balance sheets and their production is occurring. That's the part of the market that I'm not in. That's the part of the market where you can beat me.
Interesting. I appreciate you giving us an example as well, so we can hang our head on it and maybe do our maths around it as well. But in general, like if you look at this market, like are there still bargains to be had besides the optionality plays? Is there still
absolutely.
opportunity?
I mean, one that I think will be exhibiting at your conference, EMX Royalty. When I look at EMX, I think the value of the sum of the parts, chopped up and sold at auction, is twice the market cap. The idea that you are in a precious metals bull market with a company that has the ability to generate value over and above the market, selling at a 50% discount to replacement cost, that seems like an extremely attractive proposition to me. It's worthy to note, most companies in our universe, Kai, are actively seeking financing. They're selling their shares for your money. That suggests that they think your money is more valuable than their shares. EMX Royalty, by contrast, is generating a lot of free cash flow, and they're using that to buy in shares. In other words, they think their shares are worth more than your money. If you have a choice between buying a company who thinks your money is worth more than their shares and a company where they think their money is worth less than your shares, which should you prefer? This is not rocket science. I would direct people also towards Altius, another company with a very high quality royalty portfolio, a very high quality team in terms of asset allocation, deciding that for them, the best way to enhance per share valuations is to buy back rather than issue shares. My friend Doug Casey has described the return of capital to shareholders, either via buybacks or dividends, as, quote, outward manifestations of inward grace. And I've come to appreciate that quote. In the very near term, I would say the anti-US dollar trade is crowded. I think the dollar's oversold. If you look at the volatility index, the VIX, it looks like the electrocardiogram of a dead person. There's not much fear in the market. And in a market without much fear, the only class that seems to be generating fear is the US dollar. And I think in the very, very, very near term, a case can be made that the US dollar bear case is overbought. That comes apart if the Fed meaningfully lowers the interest rate on the US dollar. If the Fed meaningfully manipulates the interest rate down, that'll be a symbol to savers and investors in the world that the US society cares nothing about the integrity of the US dollar. And then it's off to the races. But in the absence of that, the US dollar trade is overcrowded. The second risk that we have in the broader resource market is the very real risk of a synchronized global recession, an economic slowdown. You can have declining supplies, and over 5 years, we're going to have declining supplies of a whole host of industrial commodities. You can have declining supplies if you have declining demand, and you don't get price increases. The weakness that we see, as an example, in seaborne natural gas, irrespective of the cut-off Russian supplies, or the lack of increase in domestic natural gas in the United States after, I will say, a profound increase. The muted response to cresting oil supplies, the muted market response, tells me that the market is either afraid of or experiencing the early stages of a recession. And while a recession doesn't end the market for commodities, probably suspends it for 2 or 3 years. I'm not saying that's going to occur, Kai. I'm not an economist, I'm a lender. But you asked me what could derail this market. And I would suggest in the first instance, absent a cut in US rates, that the anti-US dollar trade is overcrowded in the near term. And secondly, I think that the threat of recession on a global basis is very real. I'm not saying it's going to happen. I'm not an economist. That's not what I do. But it certainly makes me nervous. I actually believe that world peace wouldn't derail the gold market, because I think that the fear that really moves gold isn't fear of war. On a localized basis, certainly it is. People who live in countries that are about to experience cataclysm often buy gold. It's portable. But in the bull markets that I've lived through, Kai, what has really been the determinant is savers' fear about the deterioration of their purchasing power in fiat instruments. And it makes perfect sense arithmetically, Kai. If you get paid 4.5% to own a US 10-year treasury, if you believe that the deterioration of the US dollar is measured by the CPI, which is to say it's only 2.6, 2.7%, you feel okay. You're getting 170 basis points real yield. If you believe, like I believe, that the real rate of deterioration of the US dollar is more like 8%, you're getting paid 4.5% in a currency where your purchasing power is declining by 8%. It means that really you're losing 3.5% a year. I saw that realization dawn on Americans in the period 1968 to 1971, 1972. It took 5 years for the realization of the deterioration of the purchasing power of the US dollar to hit home to American wage earners. But when the lesson hit home, it was front and center in their mind for 8 or 9 years. And I would suspect in that regard, past is prologue. Most people around the world have been trained to believe that the US dollar, for all its warts, is, quote, the prettiest mare at the slaughterhouse. And they've come to believe that sheltering their wealth in U.S. 10-year treasuries is a very good thing to do. Americans have come to believe that too. I would argue that the next 10 years won't be unduly unkind to the US dollar relative to other currencies. But I think in an absolute sense that the US dollar will lose a lot of purchasing power. And I think that's what will move gold. I think a resolution of the dispute between Russia and the Ukraine is an example, which I hope with every fiber in my body occurs. Might reduce the gold quote by $10, $15, $20 for 3 months or 4 months. It will be the arithmetic around the deterioration in purchasing power of a whole range of currencies, including the US dollar, that will take gold materially higher. Kai, there's three things that have made me money. One, I work hard. I study. My investment technique is not got a hunch, bet a bunch. I believe that every investor and speculator on the planet needs to spend 1 hour per month studying in detail each of their holdings, reading the 10K and the 10Qs. And I know from 50 years experience that isn't the case. So if you aren't going to do the work, get out of the way or buy the best of the best or an ETF or something like that. The second thing I want to say is that you need to be a contrarian. You need to examine the arithmetic of your investment, and you need to decide whether or not the trade is crowded and whether or not the trade deserves to be crowded. Everybody seems to want to buy into something after the horse has already left the barn, which is to say, the price appreciation of an asset justifies the narrative. I'm not arguing that gold hasn't appreciated. But when I look at gold and its future relative to the US dollar, I feel less concerned about the trade. The third thing that I want to leave people with is that they have to be very, very, very patient. A bunch of my own net worth has come about simply as a consequence of compounding, owning things for a very long time. Even among the speculative juniors, you make money by answering unanswered questions. Usually, it takes 3 or 4 or sometimes 5 unanswered questions to take a stock up tenfold or 20-fold. I learned in my life, we did a back test with a couple of interns about the positions over the last 40 or 50 years that have made me tenfold or 20-fold or 30-fold returns, and the average holding period of those multi-baggers was 5 or 6 years. Many speculators, Kai, have long-term strategies, but they have short-term tactics. They have trauma holding stock over a long weekend. You can't expect a circumstance that should take 5 years to transpire to occur over 2 months. And the fourth trait that your speculators need to exhibit is tenacity. That same basket of 10 baggers, when back tested, exposed me to at least one and often two 50% declines in the share prices during the period of time that I hold them. So not only did I have to hold them for 5 or 6 years, but I had to experience a 50% price decline in my holdings. So you have to be patient, you have to be persistent, you have to be tenacious, and you have to work hard. If you aren't prepared to do that, go do something sensible with your money.
Gold and silver have once again captured the spotlight as America teeters on the edge of unprecedented financial and political instability. With Donald Trump's recent surge in polling numbers despite multiple legal challenges, and the U.S. economy walking a tightrope of inflation, rate uncertainty, and record-breaking debt levels, it has become abundantly clear that the fiat system, rooted in endless money printing and blind trust, is broken. Gold and silver are not just alternative investments anymore. They are lifeboats in a storm of economic and institutional collapse. Every fiat currency in history has eventually failed. The US dollar, once backed by gold, now floats on the whims of policymakers and central bankers. The Federal Reserve claims to fight inflation, yet it created the very problem with years of near-zero interest rates and trillions in stimulus. And now, with CPI inflation numbers still sticky and consumer sentiment in freefall, they've cornered themselves into a lose-lose situation. Raise rates and tank the economy, or ease and ignite another inflation wave. Either way, fiat suffers. But physical gold and silver, finite, real, and time-tested, thrive. In the last few weeks, silver has quietly outperformed many other assets, pushing past key resistance levels while being largely ignored by the mainstream media. Gold, too, is testing all-time highs amid global central bank accumulation. Why are nations like China, Russia, and even Poland buying tons of gold while telling their citizens to hold cash? Because they know what's coming. They know the dollar is losing its dominance and that the next financial system won't be built on paper IOUs. It will be anchored to something real. Trump's return to the headlines isn't just about politics. It's about economic sentiment. His recent statements slamming the Federal Reserve and calling for a return to sound money are echoing louder than ever. Trump understands that Americans are losing faith in the institutions that manage their money. Confidence in the Fed is near all-time lows. The Treasury is issuing debt at a breakneck pace. Social Security is on track to go bankrupt. Meanwhile, the stock market continues to float on speculation, artificially supported by Fed jawboning and tech hype. But beneath the surface, cracks are forming, young investors are waking up. They're beginning to see the trap. Save in dollars, and you're guaranteed to lose purchasing power. Trust in stocks and crypto, and you're subject to manipulation and regulatory whims. The only assets with a 5,000-year track record of preserving wealth through every war, recession, and regime change are gold and silver. And right now, silver is arguably the most undervalued strategic asset on Earth. Not only is it a monetary metal, but it's also essential in solar panels, electric vehicles, and industrial applications. The supply is shrinking while demand is surging. This is not a speculative narrative. It's a supply chain reality. Meanwhile, America is sleepwalking into another debt crisis. With over $34 trillion in national debt and interest payments now rivaling military spending, the writing is on the wall. The government has no plan to pay it off. The only tool they have left is inflation. Silent theft through currency debasement. If you're holding dollars, you're the victim. Every printed dollar makes your savings weaker. Every stimulus check, every bailout, every new government program funded by the printing press, it's a transfer of your wealth to the state. Look at the banks. Regional banking stress has returned, and big names are warning of a new wave of collapses. If even one major institution falls, a domino effect could ensue. And with FDIC reserves under pressure and trust in banks declining, people are beginning to ask serious questions. What happens to my savings if the system locks up? If you can't hold it, you don't own it, and that's why physical metals are making a comeback. Gold and silver require no counterparty. They cannot be hacked, frozen, or inflated away. They don't rely on government promises or Wall Street gymnastics. In times of war, regime change, or collapse, like the world is inching toward now, they are the final fallback. Just this week, Trump warned that America is closer than ever to losing the dollar as the world reserve currency. That's not alarmism, it's fact. The BRICS nations are actively developing a gold-backed trading currency, and the world is watching. The petrodollar era is ending, and with it, the dollar's dominance. Gold and silver will outlive fiat. They have outlived every empire that thought it could print its way to prosperity, and they will outlive this one too. While Wall Street distracts you with AI stocks and debt-fueled bubbles, the smart money is quietly accumulating hard assets. If the monetary system resets, and history shows it always does, those holding metals will have purchasing power while everyone else scrambles for crumbs.